tell people we're treasure hunters. Essentially, we go into your walls, under your floors, into your ceilings, and find tax deductions.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Weekly, we share interviews with real estate experts, passing on their experience and knowledge to our listeners. Thanks for joining us this week. My name is J. Darren Gross. We're so glad you're here. In just a minute, we're going to speak with Bill Smith. Bill's a regional director with ELB Consulting LLC. ELB performs cost segregation studies for commercial real estate owners. In the interview, we discuss what is cost segregation, how it works, and how it can benefit a property owner with huge positive return on investment, and how it can increase cash flow. Who can benefit? What type of properties work best? Bill also provides a summary available to any listener. You can click on the link and download that if you're interested in learning more about cost segregation to see if it's right for you. But before we do, I want to invite you to consider subscribing to our program. You can do that. We're on iTunes and Stitcher. You can go to either and type in the search bar Commercial Real Estate Pro Network. When that happens, you'll see our logo. It's the headphones with CREPN between the ears. Go ahead and click subscribe. This will ensure that you receive all of our episodes, and you can listen anytime you choose, whether it's in the car, at the gym, or when you're walking the dog. When you do subscribe, please leave a comment. Let us know what you think. If you do leave a comment, I'll be sure to mention you on our show. I am a little bit about me for those who don't know. If you're new to the show, I'm a real estate investor and a commercial property insurance broker. I've been an insurance broker for over 25 years. My primary clients are real estate professionals dealing in multifamily, retail, warehouse, office, and development. Also, I'm a real estate investor and have been for almost 20 years. And based on this, I'm always looking for more information so I can better support my clients and for information I can use in my own investing. And that's how Commercial Real Estate Pro Network and CREPN Radio came about. The easiest way to reach me is you can go to the contact info button on commercialrealestatepronetwork.com and go ahead and email me or give me a call, and happy to do anything I can, or just talk if you got something you want to talk about. Insurance, got to make a special note about this. It's a part of any commercial real estate transaction. If you find yourself with questions or a problem and you need to talk through it, or I just want to sound out something, see if it makes sense, go ahead and give me a call. I know there's a couple of topics that I want to put out there, issues that I've seen recently that have created some concern, and we can help. One is flood. The flood maps have been redrawn, and if a property was previously not considered to be in a floodplain, it could be now. So that's driven some clients to call. Also, earthquake. I know typically it's always been kind of a West Coast thing, but clearly now the Midwest is having a lot of earthquakes as well. If you're concerned, go ahead and give me a call, and we'll talk, and I'll do anything I can to help you. Lastly, before we get on with the show, if you're on LinkedIn, I encourage you to check out our group. We've got a group, Commercial Real Estate Pro Network. It's a great place to network with commercial real estate professionals. And if you do join, I can't encourage you enough to go ahead and check the group regularly, read, post, comment, like. It's a great community, and again, all of these communities are only as good as the people in them. So get in and get active and enjoy the benefits. All right, let's get on with our show. On the line with me now is Bill Smith. Bill is the regional director with ELB Consulting LLC. Bill, welcome.
Nice to be here, Darren.
I'm so glad we're able to do this today. Today we're going to be talking with Bill. He's ELB is a cost segregation company. And Bill, if you could share with listeners a little bit about your background and ELB.
Well, thanks so much for inviting us to this show. And ELB has been doing this for quite a number of years. Our history and founders go back more than 20 years to essentially be some of the pioneers in the industry. One of our senior partners is actually an expert witness for the U.S. Tax Court and is one of the pioneers in the business, and really came out of Georgia Tech many years ago as an electrical engineer. So I've been doing this for a number of years with ELB and with the previous firm, and our expertise is really from an engineering perspective, not as CPAs, but breaking down buildings, and I'll need to define cost segregation more for those who don't know that, but we've been doing this for many years and have done in excess of 11,000 reports with a perfect record with the IRS, so we're pretty good at what we do.
That's great. And just as a frame of reference, where are we talking to you right now? Where are you at?
I'm based in Phoenix, Arizona, and so I run our Arizona office. But we've got a number of folks across the country, but I do business for companies here in Phoenix and across the nation. I'm not limited to any territory. We just because many companies have many locations across the nation.
Got it. So to kind of set the stage and explain to the listeners and make sure everybody's clear, can you describe what is cost segregation?
Okay, cost segregation is a method of breaking down your building into component parts to then accelerate the depreciation. What this does is it increases your deductions and pushes that depreciation, which might last over 39 or 27 and a half years in the case of residential property or multifamily, into shorter term life buckets. So the impact is the time value of money. So basically you're pushing those deductions forward, increasing your deductions for the IRS. This is a federal tax incentive, thus having more cash flow to do more transactions or whatever else you might do. The history of cost segregation goes back many, many years, and there was anyone who knows Hospital Corporation of America was doing this, breaking down tangible property items into shorter life buckets. And then there was a lawsuit in 1997. They came out on top. IRS acquiesced, thus setting the stage for them to, the IRS finally established formal guidelines in 2004. So what's important for people to know is cost segregation has formalized guidelines established by the IRS. So it's not a tax loophole, or in the political arena these days, people are talking about changing the tax code. This is a tax item which actually the IRS encourages for commercial property. So we believe it's here to stay.
And compared to segregation, if somebody was not doing cost segregation, how would their depreciation schedules look?
Well, it's just a fixed rate. So if you had a building, let's say, or an apartment complex that was $39 million or $27.5 million in an apartment complex, you would have $1 million of depreciation for 27 years, or not quite, because 27.5. Whereas you push this forward, we recently did, I'll just throw an example out right now. I think people can relate to examples. We recently did a apartment complex here in Arizona that was in excess of $22 million, and we reclassified over $11.7 million in depreciation, which was 47% of the value. So 47% of that value was pushed forward into 5-year or 15-year areas, which essentially, from a cash flow perspective, delivered nearly $2 million of additional cash flow benefit to the client for the first 5 years. Much of that kind of pushed into year 1 and 2. But so the cash flow is critical. And so that's kind of how that works as an example of what that might deliver to a client.
So essentially what we're doing is you're taking the building and you're breaking it down into its different items and then applying a schedule to each item.
Yeah, so I like to liken this to in a networking thing, kind of tell people we're treasure hunters. Essentially, we go into your walls, under your floors, into your ceilings, and find tax deductions by all kinds of components. And from a technical aspect, from an IRS thing, it's essentially what's called 1250 property, which is real property. And we take real property classifications of a building that you built, acquired, improved, modified, whatever the case may be, and then reclassify certain items into 5-year property, 7-year property, or 15-year property, which is a personal property classification. So it pushes all that depreciation and deductions forward. And these include things, electrical systems, mechanical components and systems, plumbing systems, wall systems, flooring, built-in, finishing work. There's a lot of things that basically it will include that, systems that serve the tangible personal property. So that's where we find in apartments, kitchens, and all the electrical and things that support the necessary work is where we'll identify deductions that push into like a 5-year bucket. 5-year would be things in electrical and plumbing and systems like that, flooring and wall systems. 15-year would be your outdoor property, curbing, landscaping, lighting systems, things out there outside your building and on your property that would identify as a 15-year item. And again, it just pushes it forward, which thus increases your cash flow.
So in the case when you talk about like a floor covering, if you've got an apartment and you've got that new carpet on a depreciation schedule, now you're able to itemize that and accelerate that to a 5-year depreciation schedule?
Yeah, carpet, laminate, different types of flooring systems. Ceramic tile does not accelerate. One of the things that our firm and maybe others do as well is in pre-construction, we may consult with people to identify and speak with the architect and designer and say, here are things you want to consider that could make your building more tax friendly. We don't want to change our design. We don't want to impact what's going on, and we don't want to impact costs. To say, if you just take these certain items and think about those, you could potentially improve the tax friendly status of this building. Things that they may not think about, just, awnings, for example. If you bolt an awning on the outside, car dealerships and apartments and over the offices and things like that, they've got these nice expensive awnings, which in some cases can be hundreds of thousands of dollars. You weld them on, it's going to be a 39-year property or 27.5-year property, depending on the type of structure. If you bolt them on, it's 5-year property. So just simple things like that we consult to, let companies know there's a lot of components that if they just thought about them, if they're not familiar with it, it could improve. And flooring is one of those things as well.
Well, and given the opportunity to shorten that time span over 5 years as opposed to waiting 27.5 years, I think anybody that's doing their taxes would prefer the 5-year schedule. So that's
absolutely
huge. That's huge.
It's all about the time value of money. That's one of the key things, is to push that forward and give you cash flow to perhaps buy more projects. I mean, depending on whether you're opening a number of restaurants or buying a bunch of apartment complexes, it just improves your cash flow.
Right. When is the best time to perform a cost segregation study?
Excuse me. That's a great question. So most people think, okay, when I've bought or acquired or built, that's the best time to do a cost segregation study. And certainly that is a great time to do it, especially if you're building new. We use all the documentation, the AIA documents or the pay apps to kind of break down all the costs. If you acquire a building, of course, you want to identify that up front because there's some new regulations that impact. The IRS has put some tangible property regulations in 2014, which really impact tracking the different components. But a lot of people don't realize you can go back and do these up to 15 years later. So if you have an apartment complex or a warehouse or some sort of structure, and perhaps 2008 came and you've been working through that, and now you're making a lot of money, you'd like to have some deductions or some cash flow, we can go back and do that property. And so if you think about items that would have normally been, they're depreciating at 39 years, and now we can and have been for 10 years, but now we push all that and reclassify those into 5-year items, we find 40% of that property to push forward, you're going to be able to take advantage of items you didn't depreciate before and essentially get a lump sum in the first year of just a lost opportunity that you can identify right up front. We'll identify what it should have been, what you've claimed for the first 10 years, and then we'll say, here's what it could have been, and then we'll do the differentiation, all the calculations associated with reporting to the IRS. So really, there's lots of times it can be done. Our average cost seg, the age of the property that we do as a firm, is between 6 and 7 years old. Certainly a lot of brand new, a lot of new builds, a lot of acquisitions, historical renovations. Someone does a renovation. They've had a property for years, and they go back and they do hundreds of thousands worth of renovations to improve the property. We can go do the cost segregation on just the renovations or improvements and all the components therein. So it's pretty flexible. So what people don't realize is that you can go back. Then there is a form required called a Form 3115 when you do this look-back study to then reclassify those assets to submit to the IRS. But, it works great, and people do it all the time.
Is there a cap on how far you can look back?
Probably 15 years would kind of be the cap, because you've got a 15-year depreciation mode going back. We've done them, 10, 12, 15 years. Going past that, there's not a whole lot of benefit, though some people might do it because they're also going to, at the same time, they might say, hey, I'm ready to do a couple $100,000 worth of renovations, so let's go back and do the cost seg on the building and then incorporate the new renovations, which would start on a new depreciation schedule as a capitalized item, and it would go forward. So there could be some real benefit. So a lot of people, we do older ones, when they say, well, we never did it before, but now it makes sense. So we can recap that, and then it just boosts the benefit to the client.
What about somebody that's just buying a building? Building's 20 years old. It's new to you. Or when you go through and you segregate the different items, are some of those recognized as already being 20 years old, or does everything start at zero on your acquisition?
On your acquisition, it kind of starts at zero. We look at that, but then we go through and do a study for a client. For them, it just depreciates over, we'll just say it's an apartment complex for 27 and a half years when they acquire it. But if they go through and do a study, then we will identify a life to that property, and it may be 27 and a half years, it may be 5 years. We'll look at that and then make the changes. There's a component, and that's where the regulations that the IRS brought together in 2014, some enhanced tangible property regulations. So if you were to dispose, so you bought a property 20 years old, new to you, you have to replace the roof, you have to do something, there's been wind damage or whatever might happen, then you've got to dispose of the life that's left of that property. It may have 10 years left, and what's the value of that 10 years? You've got to dispose of that asset to take it off the basis value, and then you put on the new component, the improvements, which would be capitalized expenses, onto there. And that's what the regulations require for the IRS. So that brings up a point you haven't asked yet, but CPAs do this in some cases, and some are pretty good at it, because if you've got a new build, you can identify the property components, but they don't go to the engineered expertise. And once this tangible property regulation came out, our business, and I think probably most others, jumped 10 to 20%, because people recognized, CPAs said, we need the detailed work of an engineered study of, to really make the difference in, complying with these tangible property regulations. So it actually becomes a compliance component to have these reports.
And you mentioned and I'm forgetting the word, but if you have something, you dispose of it, you don't lose that. You actually then are able to account for that, the life that wasn't recognized, and bring that back on the accounting there, so you don't lose that fully, and you also then recapitalize based on the improvement or the replacement of whatever it is that you that, whether it be a roof or carpet or whatever it is.
Yeah. So if it's a roof and you had to replace 50% of it, and the life value expectancy, and we use systems, the means system or Marshall Swift, which insurance companies and all the different, building valuation things do, and replacement cost. We looked at that, and there was, $10,000 worth of life left on that roof, and you replaced, 75% of it, then you would replace, you would dispose of $7,500 of that, and then put on the additional capital expense of, let's say it was $10,000 to put the new roof on, and then that would become a new depreciation for 39 years or 27. So, again, the numbers could be 100,000 or 10,000, whatever. But we would identify you have to remove that from the basis value, and that's one of the compliance components that the IRS is kind of mandating, which is not enforced, strictly enforced unless you were to get audited, but it does with the cost segregation study. Identifying every single component allows you to then, dispose of properly this disposition of the asset, or abandonment. There's a couple of terms for that, of disposition and abandonment of the asset.
Does it require any special communication with your contractors and those that are doing the replacement work or the repair work?
No, we just need the cost, what they're doing, what type of work they're doing, the cost, and we go out and inspect the work. So that brings up a point of how this work happens, and maybe, I would imagine other people do this the same way. If it's a new build and we have all the plans and specs, our firm, all our engineers are employees of our own. We don't outsource or subcontract anything, but we will bring in the plans and specs, evaluate everything in the building, as well as all the costs, establish all the baseline guidelines, and then we go out and inspect the building to see, is it built to plans and specs? And then we'll identify, sometimes we find some things, there may have been some change orders that weren't documented, and we have to, again, stand behind this with the IRS, as does anybody else. And so we'll do the inspection after we've done the engineering work, because we've got new plans and specs. But if it's an acquisition or an older building, we would then go out and we'll get what details they've done, but we do all the inspection and measuring and evaluate everything, the riser rooms, the underground utilities, everything that's on the property first. Then we come back and basically re-engineer the building. And so reverse engineering, you do all our engineering work once we've established the baseline, the site, everything on there, tons of pictures. So depending on the type of property and when you pick it up is when and at that time, then we identify all the systems and all the costs, and we have the generalized cost records that everybody uses that are the industry standards from Means or Marshall Swift to identify components. So, if we've got the contractor's components, that's great. We'll identify those. Sometimes we have to reconcile the difference between those if they're discounted and what, replacement value would be from a industry perspective using those other, systems which are recognized.
So I want to back up here 1 second, make sure I understand. So you guys, if say I buy an apartment complex and I have you come out to do the cost segregation study at the very beginning, and we go through and you produce your report and it gives us a baseline for everything. And then 3 years into it, I've got to replace a roof or anything else. Am I then contacting you or whoever I had do my cost segregation study to come back out and reevaluate, or is it because I've got the study done that I can, apply the replacement to the study and do the recapture that way, or is it a reevaluation?
It depends on the level. If it's just a repair replacement, and the expertise, but we can then do an implementation or a revision of our study and do the abandonment and disposition of that. If we just get the details, once you've got the baseline, as you mentioned, then if you come back and have to do a replacement or you do improvements on individual units, as you buy the property and people are moving out, you might have a 3-year plan. You're upgrading floors and kitchens and all the things that are happening now in the multifamily world. We can then go through and then do the disposition of those assets for replacement of just normal stuff versus, a replacement of a roof, which might have been damaged. So the CPA or the client would have information about that and could find the life of that. But typically we're contacted, we're given the data, we just do a quick update, for a nominal fee. Just give them, so again, they've got the data they need to stay in compliance. And then if there's ever an IRS audit on what they've done, we would stand behind it. And I presume most others will stand behind their work as well.
Got it. So what kind of buildings, what's the best type, or what type of buildings qualify for a cost segregation study?
Well, essentially, any building, any commercial property will qualify. And so, multifamily are great buildings. We do a lot with apartments, whether it's a garden style or a mid-rise, high-rise. It doesn't really matter. Auto dealerships, assisted living, warehouse, Amazon-type warehouses, distribution centers, car washes, hotels, motels, resorts, golf courses. Our portfolio of work includes countless Costco's, the Bellagio. We did work that we did Augusta National and the Blue Monster down the Doral. Or now I guess that's the Trump course, but, medical office buildings, office condos, they're great. I mean, anything that's, some of the companies will say they want $1 million or more because of our detailed approach. And I don't really want to do an advertisement for us, but our study is what's called fully engineered and accounted. We break down everything in the building, pretty much down to except for the sheetrock screws, but everything else. Most other companies do that are good do engineering based. So it's close, but it's not quite the same. They don't get all the details and partition out and percentage out certain components that can be broken into 39-year and 5-year classes, where we'll do that. And there's a number of other 6 different categories of study that the IRS has authorized, from a rule of thumb, which is basically a swag, to a fully engineered report, which when they defined their guidelines in 2004, they used our report as the baseline for that. But going back to buildings, retail, self-storage, anything. But again, office condos are good. And if it's $300,000 or more, because of our detailed approach, when I was going into detailed, we can start to justify and make benefit. The higher the value of the property or the property improvements, this doesn't include land, of course, then the higher the ROI and the cash benefit to the client. Because there's a certain amount of work that has to be done. But once it's done, then it accelerates. As I mentioned before, we did a $22+ million apartment complex, found 47% depreciation, $11.7 million for the client, and which was nearly $2 million in cash flow over the first 5 years of the property. So at a 35% tax bracket. So the benefits are good. On a office condo built out for a dentist or doctor or somebody, insurance attorney, doesn't matter. They're going to see $100,000 worth of benefit, a couple $100,000 worth of cash flow benefit if they're at $300,000 to $500,000. We're going to find anywhere from 25 to maybe upwards of 50%, depending on the details or the, as you might say, the bling associated with the building. If it's a simple shell and doesn't have a lot of detail work, you're not going to find as much. But high-end restaurants with specialty lighting and drop ceilings and built-ins and cabinets and all that kind of stuff qualifies. Just a simple shell, doesn't make a lot of sense. So again, most any building will qualify. Depending on this type is really how much more it will qualify. Manufacturing is big. We might find upwards of 60+% on a manufacturing facility because of all the infrastructure and electrical component required to support the manufacturing process. Where a distribution center will be, same type of external structure, envelope, but it may be, much lower. Might be in the 20 to 40%, depending on, what type of systems they have for automation internally. If it's just, gas forklifts or electric, there's not a lot of stuff in there. It just depends on, again, the support system. Fitness clubs are big. They got all the electrical to support all the systems all over there. Big, fitness clubs make a difference. So I've jumped around, but again, it's any building.
Yeah, no, I think the illustration and just kind of the picture of what type of property really fits is useful. What is there any ownership structure requirement, or on the ownership basis? Is there any limitations or?
Well, if it's, into a REIT that might be tax-free, it kind of gets into what are the qualification requirements. So that's important for people to know on this call. So if you really want to look at what's it take, first thing you've got to be, have a tax burden or have a federal tax liability to take advantage of it and be a for-profit entity. If you're a not-for-profit, it doesn't matter because you're not paying the IRS taxes. So you've got to have an IRS tax burden. Then there's the size of the property we talked about, which would be, $300,000 for maybe a leasehold build out, which I didn't mention. Leasehold makes sense for people in the type. I didn't mention that before because leasehold starts at a 15-year depreciation. And if you're paying for it versus the landlord and he's doing your TIs, you're building your rent. But if you're paying for your TIs, like a subway, we do a lot of subways and firehouse subs, things like that. Guys have 2, 3, 4, 6, 10 of those or more. You're at a 15-year depreciation schedule. Most of the things you build out, we can push to 5, so it makes a lot of sense on that. So that's one of the things that I wanted to point out that I had overlooked on the suitable property types.
Got it. I had a question. I'm just trying to think. We were talking.
Yeah, but I'm going back through. I jumped. My brain jumped a little bit on the eligibility. So you need to be for profit, and you have to own it for probably less than 15 years. We'll go back about 15 years. So again, it doesn't have to be brand new, a brand new build, brand new buy. It can be a 100-year-old building, but if you're buying it today, you start over because it's your depreciation schedule. It's not about the age of the building. It's about the ownership and the ownership structure you mentioned as to who can be owned. The valuations, as I mentioned, $300,000 on TIs make a lot of sense. This is improvements, not land. On the property improvements, including renovations, $300,000 to $500,000 is kind of the minimum where it starts to make sense. But for the ownership type, if it's LLCs, which let's say, just for example purposes, a dentist builds an office out, or a doctor buys an office condo, builds it out. They usually have an entity of their own that owns the building, and then they have their dentist shop, and they pay themselves rent just for your operational structure for two entities. If it's an LLC, then the ownership percentage in that LLC and the benefits pass back through to the owners proportionally. So it becomes a pass-through deduction to the owners. If it stays within a corporation, then of course the benefits are there within the corporation. The key thing is to be taxable from an ownership perspective.
Got it. I wrote down my question so I wouldn't forget. Is there a key number of years that an ownership should be looking to hold on to a property?
Yeah, so if you're really opportunistic and turning properties quickly, it may not make a lot of sense because there's a recapture rate. So if you were to do like that, $4 million property I talked about, and the guy found 47%, or we identified 47%, $11 million in depreciation, move forward. He's benefiting, his cash flow, nearly $2 million over 5 years. He sells it in year 3. He's taking a lot of benefit from the IRS. There's a recapture rate. So, you really want to hold in excess of 5 years. Some people use the rule of thumb, between 5 and 10. If your hold periods between 5 and 10, it makes sense to look at. Now, we have some clients and some REITs that just do it on everything, large national companies, and they're looking at the cash flow. So they're not necessarily sure what's going to happen with that property, and they'll deal with the recapture rate on the back end. If there's capital gains, the capital gain impact may be smaller than the direct taxable impact. So it really depends. It becomes a financial strategy and discussion we have with the client and the CPA as to what will do that. But, in general, people say if you excess of 5, maybe 7 years is kind of maybe the magic number where if there's recapture, you're not going to get hit real hard. Because if you take a lot of benefit from the IRS up front and sell it right away, IRS says, wait a minute, you took, right. 2 million deductions and you owe us money. So.
Right. That makes sense. I got a question for you. What percentage of property owners do you feel like, in your experience, are taking advantage of this cost segregation as opposed to running a straight line or more of a CPA effort?
I think it's highly overlooked because a lot of people think it's more of a Fortune 500 something or CPAs. CPAs are a driving force behind this because they're doing the client's taxes, but some CPAs are just doing taxes and not really providing year-long consulting. So we're probably 20 to 25% of the companies are taking advantage of it. There's probably another 20% or more that, just don't qualify because they're non-tax REITs or whatever. The ownership structure doesn't make sense, non-for-profit. But there's a huge opportunity out there for buildings, again, of all sizes, from 3 to 400,000 up to $1 billion or more, of a entire shopping mall complex. I mean, again, there's a vast range of properties. We did a whole Main Street for a town here in Arizona. Someone bought the town and bought the whole Main Street in the commercial multi-use section. We did that for them. So again, the opportunity is significant, and people just don't really know about it. And they think, well, why didn't my CPA tell me about this? And they're like, he's screwing up. And not necessarily, he or she, excuse me, because they have so many regulations to look at. This is just one component. And we have, reams of paper, just the guidelines for cost segregation. CPAs have so much to do. So we really work in unison with the CPA to enhance their job. We work a lot with direct owners. Some CPAs say this is great. They want to do it for their clients. But, in many cases, I work directly with the owners and then coordinate with the CPA any details, or if it's an older building, what tax asset detail they already have. So, again, we want to reconcile and tie to the CPA's numbers to make sure everything works through. So we always coordinate with the CPA, whether they bring us in or we work with the owner and we do the report and then tie into what the CPA already has, especially on an age building. If it's a new building, they look to us for everything because it just makes their job so much easier.
So what do you say to somebody that says, well, my CPA, he's got that taken care of? Do you guys ever take a look at studies that have been done by others and find additional benefits, or?
Yes, we do, and that's a good question. So we had one example of a hotel property down in Houston, Texas, just a moderate hotel, $12 million property, I think a Holiday Inn Express or something. So not a highly elaborate hotel, but a nice property, and it was $11 million, I think, in improvements. And the client was like, yeah, well, our CPA did it, and we're covered. And we said, okay, well, let us take an audit because this was an opportunity. They had multiple properties. So let's just audit the work. So we did a free audit, and the CPA did do a great job. It had been a new build, and so they can look at, the cost documents, identify 5 and 15-year property, relatively easy. However, in that property alone, we found over $1 million worth of additional depreciation just in the electrical system. So things that the CPA can't do or is not qualified to do, is not an engineer. And so as a result, that client said, wow. And so now we're doing all their design guidance or pre-construction planning for them to maximize their opportunities in the future. So we do audits for people. We actually do audits for the IRS. They send us work sometimes before they audit others to take a look at and give guidance, because as I mentioned before, one of our principals is a U.S. tax court expert witness, so we have a very good reputation with the IRS. Another example, this brings up an example we did. A big manufacturing company in Florida had done some work. They had multiple plants. They got audited, and they were kind of in trouble. And they called us, our firm, and we looked at the work, and it was poorly done, and they would have had problems with the IRS. But what we did is we essentially went back and redid another cost segregation study, reclassified everything, and did it right. And in essence, they would have actually gotten more benefit from us. And so we saved them. We were called in as experts by the client. We saved them from the IRS and the audit, which they would have had huge penalties. But because the report wasn't done properly, we corrected it. We did it right. Everything was reclassified. They came out smelling like a rose, and they said, hey, we want you to do our other plants. So, we do specialty work for clients to identify additional opportunity.
Well, Bill, this has been very informative. I think the my takeaway from this is that there's at least probably half of the building owners out there that are not taking advantage of it, that would benefit by engaging someone like yourself to have a cost segregation study done and be able to accelerate their depreciation and thereby increase their cash flow. Is there anything that we haven't touched on that we should address here?
I think we've pretty well covered it. There's so many different nuances and specifics per building or per situation that if one of your listeners is interested, we're going to post the document that gives kind of a quick recap, a few examples, and kind of the criteria behind a cost segregation study. We're more than happy to answer any questions. And then one of the things that we do, and I will say pretty much any other cost segregation firm will do, is a free feasibility assessment. We call it a feasibility, where we'll take a look at the property, identify the components. We do a lot of research on it, and then come back and say, here's what your tax benefit would be should you do a cost segregation study. Because there's, again, nuances. There's more to talk about. It's boring engineering. People go to sleep. That's why it's likened us to treasure hunters, because people go, oh, treasure hunter, that sounds interesting. What is that? So we just find cash. And so, this document that you'll post will give kind of a quick recap of our discussions, kind of the key points, and then a link, my email address. Anybody wants to have any questions for me, I'm happy to address them. But, if you qualify for one, you need to take a look at it, and you need to call a couple of different companies, get a couple of proposals, a couple of bids, and then look at a sample report. That's critical, is seeing the type of work that's done, because a lot of people take shortcuts, and that's one of the things I'd like to warn about, is they'll find the easy stuff, and they'll spend less time and less money, less engineering, and they'll get a report out, which will provide benefit, but it won't maximize the benefit. And so our level of study, which is fully engineered and accounted, it takes into account everything and percentages out components that the others just don't do. We know because we've pretty much seen all the reports out there. So that's what I would just leave with your listeners, is get a couple of estimates and take a look at the sample report, do a WebEx and take a look. And of course, I'm happy to speak to anybody and do an assessment for them if they're interested.
And for those that are interested, what's the best way to get in touch with you?
Just give me a call. My email address is bill@elbcostseg.com. Hopefully it'll be on your post. There'll be a brochure there. I've got a phone number in Arizona, 480-747-5547. That's 480-747-5547. Give me a call direct to my office, and then we'll be happy to answer any further questions, prepare an assessment, and determine if it's right for you.
That's great. And for the listeners, I want to remind you the document that Bill referenced, that kind of spells out and summarizes if cost segregation might be something that you could benefit from. It's going to be on. There's going to be a link in the show notes. So go ahead and click on that, and you can download that and take a look at that and see if it's something you want to pursue. Bill, I want to say thank you for taking the time to talk with us today and educating us on cost segregation.
My pleasure, Darren. Thank you so much, and we look forward to speaking to some of your listeners and following up with you on more details.
All right, we'll talk soon. Thanks, Bill.
All right, thank you.
Well, if you haven't done or considered doing a cost segregation study, based on what I learned talking with Bill, I would encourage you to do so. Also, be sure to grab the cost segregation summary Bill mentioned. It's in the show notes there. There's a link to it. It spells out if this will make sense to you, and also it'll break down whether or not that's a good idea for you to do. I hope you found today's episode enlightening. We know you're busy. We thank you for making time for us today. We do appreciate you. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.